How IUL is the dream solution for a myriad of financial goals.
Well, why are you continuing to postpone, procrastinate, paying tax to some future perceived unknown advantage, and then withdraw your money out of an IRA or 401k when taxes are going to be higher? Most advisors use life insurance for death. They should call it death insurance. We use life insurance for living benefits, for tax-free accumulation, access, and transferability, for the living benefits so that every $1 million can generate a 10% payout without depleting principal.
In this episode, I'm going to go through and address several different ways that I have successfully incorporated property structured, max funded, indexed universal life to achieve all kinds of financial goals for thousands of clients in the 5 decades that I've been helping people optimize assets and minimize taxes. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 50 years. And when I tell people that my favorite thing is helping people optimize their assets and minimize taxes, they say, well, what's the best financial instrument or investment that you've recommended? Without question, I go, well, a properly structured, max-funded, indexed universal life, because it is the dream solution for a myriad of financial goals. It's like a financial Swiss Army knife. And so I began to use that metaphor, and let's just go through them one by one. I've done various episodes on this, but let me go through and summarize the ways that it's a dream solution. So as a dream solution, it means it's going to contain some key elements of prudent investing. And I have those in order: liquidity, safety, rate of return, and the tax benefits in that order. And that's why we call these liquid assets safely earning returns, which spells L.A.S.E.R. Okay, that's why I call it a L.A.S.E.R fund. If it's been properly structured and maximum funded, it passes the liquidity, safety, rate of return test with flying colors, and it's the most beautiful tax advantaged instrument in the entire Internal Revenue Code, in my opinion. Okay, so when we set up an IUL, you have to justify a death benefit, okay? Most people never came to me primarily with the goal of wanting or needing a death benefit, even though they loved that whatever they set aside, if they happened to die, that it would be self-fulfilling because it would blossom into a death benefit, okay? But the majority of my clients, at least 50 to 60% of them, would come to look at ways to sock away their money for future goals like retirement better than IRAs or 401ks, so they would not outlive their money due to the negative impact of taxes, inflation, and market volatility. So retirement planning became a very popular objective. It's the dream solution. In my opinion, a property structured max funded IUL knocks the socks off of an IRA or 401k, or even a Roth IRA or 401k. And let me explain quickly why. See, a lot of times people, I think, are duped into putting money into pre-tax 401ks or tax-deductible contributions to IRAs or 457s or 403bs or the like, being told, oh, you'll likely be in a lower tax bracket when you retire. Well, that has not been true or axiomatic now for over 30 years. Most savers in America, when they hit retirement, they're not in a lower tax bracket, okay? Several reasons for that, but basically it's because you've continued to defer, procrastinate, and if you're a saver, now you have a pretty good nest egg, but you're not in a lower tax bracket. You've actually been killing your tax deductions probably because you paid off your house. The kids are gone, and even if they move back in as adult children, you can't deduct them anymore. You're not contributing money to IRAs or 401ks in retirement, so you don't have those deductions anymore. If you're a business owner and you sold your business, you don't have those deductions anymore. And what else? Well, Congress, because of irresponsible government spending and the printing of money, taxes are going up. Most Americans, when I ask them in an audience, how many of you think that taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? 1 or 2 people raise their hands. But when I say how many think that taxes will likely be higher,
a sea of hands goes up. And I go, well, why are you continuing to postpone, procrastinate, paying tax to some future perceived unknown advantage, and then withdraw your money out of an IRA or 401k when taxes are going to be higher? And they just looked dumbfounded, like, I don't know, that's like, you put it that way, that's really stupid. Yeah. And so sometimes people say, well, what's better? Is a Roth better? Well, yeah, it is a step in the right direction. Roths were passed in 1997, but the government didn't do it for you. They did it for themselves. They didn't want to wait around until people retired to get the required minimum distribution taxes on those IRAs or 401ks. They needed tax revenue, so they knew that savvy people understood that it's better to pay taxes sooner than later and enjoy tax-free from that point forward. So they want to convert to a Roth and pay the tax and then enjoy tax-free income thereafter. And that created a windfall of tax revenue for the government. It was a step in the right direction, but I've never owned an IRA 401k, never will, but I've never owned a Roth IRA 401k, never will, because my favorite vehicle, a max-funded IUL, which, if it's structured correctly, is deemed a L.A.S.E.R fund, liquid asset safely earning returns. It knocks the socks off of any Roth that I've ever seen. Roths have basically two advantages. You fund them with after-tax dollars, like you do a L.A.S.E.R fund, but your money accumulates tax-free. You can access it tax-free. A L.A.S.E.R fund has had those two advantages for over 108 years now in the Internal Revenue Code, Section 72E, 7702, and 101A. It's the only vehicle in the Internal Revenue Code, in fact, that allows you to accumulate your money tax-free, then be able to access that money income tax-free, and when you die, anything left behind blossoms, increases in value, and transfers income tax-free under those three sections of the code. Well, if you use a L.A.S.E.R fund, it has 4 additional advantages Roths will never have. In a nutshell, I can set up a L.A.S.E.R fund to accommodate $30,000 a year of contributions, $300,000 a year of contributions if I'm a business owner. You can't do that with a Roth. In fact, if you make too much money, you can't even own a Roth. That's why savvy CPAs and tax attorneys refer to the L.A.S.E.R fund as the rich person's Roth. And I snicker because you don't have to be rich to have a L.A.S.E.R fund. You can set one up for $500 a month. But see, if you make too much money, you cannot have a Roth. So you can design it to accommodate $300,000. You can put in $30,000. You don't have to put in anything. It's that flexible. Now, what's another advantage? Well, if you put in $300,000, let's say during a banner year, and then a few months later you see an opportunity or you need money, you need to access $200,000 of the $300,000. You can't do that with a Roth. You can't access money for 5 years until you're 59 and a half without a 10% penalty. In a L.A.S.E.R fund, I've had people put in $300,000 for a year or two, and they're not even 40% funded. They can go grab $200,000 with an electronic funds transfer or phone call. There's no 10% penalty. So I have flexibility to access the money and become my own banker, okay? What's the next advantage? Indexing. Roths don't allow you to be able to link to the market to where your money participates when the market goes up, but not lose when the market goes down because your money is not at risk in the market. It's called indexing. I'm not talking about an index mutual fund. The sixth advantage is Roths don't blossom when you die. If I happen to die in an accident tomorrow, every million I might have in a portfolio of L.A.S.E.R funds would blossom to about $2.5 million and transfer tax-free to my heirs. And people go, whoa, well, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that most people shell out in unnecessary tax, okay? And so for retirement planning, it knocks the socks off of IRAs or 401ks or Roth IRAs or 401ks. Why would you mess around with them, okay, with all those rules? Now, what about college savings plans? Many Americans are socking away money for their kids or grandkids for college, and then they put it in a 529 plan so that it accumulates under a tax-advantaged umbrella. And I'm going, yeah, but that doesn't allow very much flexibility. What if your child gets a scholarship or doesn't need the money? What if they work their way through college like I did and my kids did? If they want to use the money in that 529 plan for a down payment on a home
or to start a business because they got a scholarship, they have to pay tax on that 529 money now. Why do that? Why have all these strings attached? If I use a L.A.S.E.R fund for my college funding for my kids and grandkids, it's always tax-free, no matter how they use the money. They don't have to use it for college and it's still tax-free. But again, if I'm socking away money into a L.A.S.E.R fund for college funding and I happen to die, all of a sudden the college funding is funded in one fell swoop because it blossoms to a death benefit tax-free. So if I set it up, I'm socking away $500 a month towards my grandchildren's college, and I die, all of a sudden there's going to be $100,000, $500,000, $1 million in that account instantly because of the death benefit. 529 plans don't do that. Let's look at business owners. Many times I'll run into a business owner and they have working capital accounts because we need money in the bank or whatever accessible to be able to buy inventory. As an author, I print usually 15,000, 20,000 books at a time. And then I go through, and as I ship those out, in a few months, I need to print another 15 or 20,000. Well, you've got to be able to write out a check for 30, 40, 50 grand to the printer every time you do that. So it behooves me to have a working capital account. Well, instead of having your money sitting in a bank or credit union earning next to nothing, put it in a L.A.S.E.R fund because it's liquid. It may not be a drive-up window, but it's still very, very liquid. I can access money within 24, 48 hours, and I'm earning more like 5, 10, 15% rates of return on my working capital. But when you understand how money works, hear this. Many savvy business owners, they understand how to become their own banker. So for example, in 2017, one of my business owning clients, he borrowed $1 million out of his L.A.S.E.R fund. Why did he borrow? Well, because he understands that if he leaves the money in his L.A.S.E.R funds, he had over $1 million in there, so he left the $1 million there in his L.A.S.E.R fund. And in 2017, he got credited 25% tax-free, $250,000 on $1 million. But he needed $1 million to tie up a piece of property that he was going to fix up and flip and make $2 or $3 million on. Rather than withdraw $1 million out of his L.A.S.E.R fund, he borrowed $1 million from the insurance company. He didn't have to qualify because the insurance company will loan him the equivalent of the money that he has in there because they've got the collateral. By doing that, they'll charge him 2%, 4%, 5% interest, depending on what kind of a loan he does. If they charge him 5% on $1 million loan, that's $50,000 after a year, but they credited him $250,000. He made a net of 20% or $200,000 on his money while he was actually using it in his business. This is incredible. That's a working capital account. The same is true with real estate management. I've run into many real estate investors and they make the mistake of taking positive rental cash flow and, okay, well, I don't need this money, so I'm going to pay it against the mortgages. And I show them mathematically, why are you doing that? What if you need that money back? Now you're going to have to borrow it back from the mortgage lender again. Many landlords get into trouble. So the savvy landlords do what? They take the positive cash flow, they keep their properties mortgaged to the hilt, and like I have done for years, they borrow money at, let's say, 4.5% tax-deductible interest or 6% tax-deductible interest, but in a 33% tax bracket, 4.5% is really a net cost of 3. 6% is a net cost of 4. In their L.A.S.E.R funds, they're earning 8, 9, or 10. How much more is 8 than 4? It's 100% more. How much more is 9% than 3%? It's 300% more. Would you hire an employee for 30 grand that made you an extra 90 grand? Would you buy a widget machine for 30,000 that made you an extra 90,000? They're making 300% rates of return on their money while they're making money on the rental property anyway. So they take the positive cash flow, put it into a L.A.S.E.R fund, and the L.A.S.E.R fund compounds and grows tax-free at 3 times the net cost of the mortgage. And they will actually have enough money to pay off the mortgages 2.5 years faster than if they sent the money to the mortgage company and killed their best partner, Uncle Sam, in the process, getting rid of that tax deduction. Is that making sense? It's an incredible dream solution for real estate management. Well, what about an emergency fund? Do you know in 2008 when 400 banks went under, 900 more were on the watch list on the brink of going under, and that's when the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. Guess where they had it? Banks and credit unions had their money in the multi-trillion-dollar insurance companies. And they were paying you, who put money in their bank, 1% interest at best, and they were turning around and making 5% or more in the insurance company. How much more is 5 than 1? Don't say 4. It's 500% more. On every million, they were paying $10,000 annual interest, and they were earning $50,000 of annual interest. That's 500% more. You can do the same thing, bypass the middleman, but they also increased the safety, because most of these insurance companies that they put their money in were ranked AAA. Most banks were only rated BBB. They took your money and increased the safety by 6 notches and increased the rate of return by 5 times. You can do that with your own emergency funds. In this day and age, you can get your money within 24, 48 hours with an electronic funds transfer or phone call. How about a lump sum? Capital transfer is what we call it. There's a lot of people that experience lump sums of money, a little windfalls, maybe a settlement from a car accident, maybe an inheritance, maybe from the sale of a business, maybe an early out option for retirement, whatever it is. They come and they say, Doug, what do I do with this lump sum that I just got, this 100,000, this 500,000? I go, well, how would you like to have that 100,000 or that million generate a 10% payout, $100,000 a year of tax-free income? Well, where do you get that? In a L.A.S.E.R fund. Because every million can generate that kind of a cash flow if you need it tax-free, or you put it into a max-funded insurance contract, and if you happen to pass away, it leaves behind double or triple what is in there, okay? Other accounts will not do that. It knocks the socks off of other alternatives. It's the dream solution for any lump sums you get. Well, estate planning, many times people are trying to maximize what they leave behind to their kids and grandkids when they die. And so they sometimes get life insurance in order to cover expenses such as estate tax, inheritance tax, or maybe it's so that their posterity will not have to pay off the debt. Well, life insurance is a way to pay off or settle those things for pennies on the dollar. So they buy insurance for that benefit. I'm saying, well, why would you just have insurance to do that? You maximum funded. Every $1 million you put into a max funded IUL can generate $100,000 a year of tax-free income without depleting principal based on actual historical performance. But why would you leave behind, $1 million when you die when you could leave behind, $3 million if it doesn't cost you anything? And people go, well, why doesn't it cost you anything? Well, insurance isn't free, but it comes along for the ride. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax. You'd have to be earning 15% to net 10 in any other kinds of investment. With the max funded IUL, you only have to earn 10 to net 10. But in actuality, with rebalancing and diversification, I've earned 11 to net 10. That 1% difference pays for the insurance that if I happen to die, it'll leave behind 3 times as much money. I'm not paying for it. It's being paid for with money that most people shell out in unnecessary tax. Does that make a little bit of sense there for you? I'm going to show you how you can learn more about this. But when we talk to school teachers, police officers, firefighters, many times they don't realize when they go to retire, the state offers them a defined benefit pension based upon the years of service, if they taught school for 30 years or whatever. And they show them the benefit, but then they say, well, you ought to take a reduced benefit so that your spouse will continue to get a benefit if you happen to die first. Well, it sounds pretty good, but what if your spouse dies before you? Oh, they say, well, if you get remarried, no, we will not pay it to another spouse, and we don't give it to your children. It's only throughout your lifetime. Well, that's the stupidest, most expensive insurance policy you'll ever buy. Why would you do that? You can take the maximum benefit from your pension, take the differential between that and the survivor benefit amount, put that into a L.A.S.E.R fund, and it doesn't matter if your spouse passes away before you. You can rename new beneficiaries and your children, and you can access the money. It is far better use of that money, and it will leave behind more. It will generate more than the state's pension plan will on the same dollars, I assure you. Well, what about general tax reduction? This is very popular. This is where so many people, they follow the herd, they put money in tax-deferred IRAs or 401ks, and then they realize they're in a tax trap. So I have to free them from that, and we do strategic rollouts. Not a rollover, that's a rollout. This is where you're getting the money out of those IRAs and 401ks strategically, getting the taxes over and done with sooner than later, repositioning the net after-tax money into something, a L.A.S.E.R fund, that's going to be tax-free from now on, and then when you die, it blossoms and transfers tax-free. It will do far better than leaving the money in 401ks and taking RMDs. So in my book I want to gift you, there's stories and examples of how we took a husband and wife, both school teachers, and we saved them $250,000 of unnecessary tax and doubled their income over following the herd and keeping their money in 403bs and 401ks. I took a real estate landlord and saved him $750,000 of unnecessary tax and 4 times his income over where his money was in his 401ks. We took a husband and wife, both physicians. They had $4.6 million saved. They were going to end up paying $2.6 million in tax by taking RMDs and spreading it out. I could not save them the $2.6 million in tax. I saved them $1.2 million. That $1.2 million we saved them in taxes, generating $100,000 a year of tax-free cash flow. They absolutely loved doing that strategic rollout. We took a couple in California from the highest tax bracket to a 0% tax bracket in 4 years and 1 day. They had $6 million in IRAs and 401ks, bit the bullet, paid a third, $2 million in tax, put the net of $4 million into L.A.S.E.R funds, 4 L.A.S.E.R funds. That $4 million in 7.5 years doubled to $8 million. They now have $8 million tax-free, and they're in the lowest tax bracket, a 0% tax bracket. We do this all the time. So when we look at it, many times I'll ask audiences, golly, what are some uses for baking soda? And usually the women in the audience will say, well, it takes the odor out of the refrigerator. You can soak in the tub. The men use it to clean their battery terminals. And then finally somebody goes, oh, it's good for baking. Yeah, the obvious, baking soda. Well, it's amazing. We use life insurance for life. Most advisors use life insurance for death. They should call it death insurance. We use life insurance for living benefits, for tax-free accumulation, access, and transferability, for the living benefits so that every $1 million can generate a 10% payout without depleting principal. It's far better than all these other alternatives like IRAs and 401ks. So I say don't focus on what it is. Yeah, it's life insurance. People say, well, I don't need any. Well, okay, what does that have to do with it? Make me the beneficiary. Look at what it does. When I show people what it does, they go, well, this is by far better than all these other alternatives. What is it? I go, it's life insurance. Oh, we don't need any insurance. I'm going, okay, then again, make me the beneficiary. Quit getting hung up on what it is. Look at what it does. So if you want to learn more, I would strongly recommend you study and immerse yourself in my 300-page book, The L.A.S.E.R Fund. This is actually 2 books in one. The white covered side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you learn more by stories. You flip over to the orange side. This is about 100 pages, 12 chapters with 62, actual client stories. If you want to use your whole brain, then read both books, okay? But you simply go to laserfund.com or click on the link below. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. I'll fire out a hard copy to you via priority mail while you're in there claiming your free copy. If you like to listen and learn, watch and learn, there's those formats. But we teach regular educational webinars. They're free. You can register for one of those. But if you want to talk to a certified IUL professional, then with no cost, no obligation, you can schedule an appointment, a quick consultation, absolutely free, with an IUL professional that I oversee to see how this may help you in your particular set of circumstances without increasing your outlay one dime. They can show you how much better off you would be by optimizing assets and minimizing taxes using a L.A.S.E.R fund.